We are live. Is 2026 going to be like 2009 when it comes to non-performing mortgages? That's what we're here to talk about today. And of course, I'm Patrick Franz. You know, my channel is all about health, wealth, and legacy. And in today's video, we're talking about non-performing mortgage notes. This is a way to build wealth on one side of it, and it's another on the other side. There's a way to help homeowners avoid foreclosures and those kinds of things. So that's what I want to discuss today. We're talking about the paper side of real estate and in investing in mortgage notes. And some people don't even realize that you can invest into non-performing mortgages. It means that homeowner is living in the house and they've become delinquent and they're not paying on their mortgage any longer. And as we know from the big mortgage meltdown in 2008, many people were just walking away from these homes, and the banks and the funds and the institutions out there that hold a lot of these mortgages in their portfolios were caught between a rock and a hard place, in which they didn't have the inventory available, or excuse me, they didn't have the infrastructure available to deal with all that non-performing inventory. How many loan modifications, reach outs, judicial foreclosures had to go on if you owned millions of mortgages and, near 40% of your portfolio stopped paying. So they found themselves in an interesting situation in which they had to sell these non-performing mortgages off to the secondary mortgage market, where investors like you and I can participate in buying them as an investor. But it flooded the market with tons of inventory at pennies on the dollar. And it was, a sad situation for many people out there in the marketplace, homeowners and that. We never want to see, bad situations in the economy affect people, our neighbors and friends and family and those kinds of things. So it's a terrible situation. But as we know, if you're a Warren Buffett style investor, a lot of the time, that's when the money to be made is there. The opportunity is there when there is some type of blood in the streets. And so today I'm talking about being able to help more people out there, families, avoid foreclosure. I can get into a little bit of that, where they're not just a number to a large institution. As a note investor, we can sometimes do things that maybe a large institution would not do to help families out in these situations. But the point of the video, once again, is it is today's market in the real estate and mortgage market. Does this market appear to be creating a witch's brew or a soup with these ingredients in the soup, pointing at the fact that 2026 could see a very, very large surge in non-performing mortgages, as in 2009. But let you be the judge. One of the things that I was reading on is the rise in delinquency rates that are happening right now. And, mortgage delinquencies, not deemed to be non-performing. To have a mortgage go non-performing, as a lot of us know as the borrower, we have to be more than 3 months late, and then they can deem it to be non-performing and take action. But if it's just 30 days or 60 days late or something like that, it's deemed to be non-performing debt. It's in that transitional period. And there's just a very huge increase of these 30 and 60 and 90-day lates, steadily have been increasing since 2024. And the early stage delinquencies like that, are kind of the first domino to fall. And, before non-performing loans become more rampant. So major loan servicing companies are, really tightening down collections as well. And, this kind of thing, guys, is sort of a preparation before they move bulk assets to the secondary market. In the consumer debt crisis that's going on, as you know and understand, is, a big problem. Credit card debt in the United States surpassed $1.3 trillion in 2025, and that's an all-time high. So the household savings from all these stimuluses and COVID and those kinds of things, that's, long gone. Some families are financially vulnerable because of this. And then, the rising debt in the American economy, means that missed mortgage payments are coming next, right? It just points at that. at that problem. So, what we look at too is interest rate shocks. We've seen that the, mortgage meltdown of what happened in 2008. If you watch the movie The Big Short, which is, um, in my opinion, a pretty good movie, anyways. Just if you like movies, that's a great cast and great actors in that movie. But the movie's about um, the mortgage meltdown, what happened in 2008. And so a lot of people understand that the reason why that happened was sort of like what they call predatory lending. And it means that all these lending practices with ninja loans, no income verification, no qualification type loans, adjustable arms, and things like that were rampant in the space. And that's what sort of was a big cause of the mortgage meltdown. Well, they weren't supposed to be doing that anymore. The restrictions in the mortgage lending market, tightened up, and they were supposed to stay away from that because look, that created a disaster worldwide last time. Well, no, between 2021 and 2023, there's been lots of those types of arms and those kinds of things that now are beginning to reset. Um, and that creates a problem, right? Can you imagine a payment increase on your mortgage of 30 to 70% increase when the loan adjusts? A lot of people just can't afford it any longer, so it's going to create issues, just like it did in '08. The foreclosure and the bankruptcy filings are certainly climbing as well. I was looking at that, and they, pre-pandemic levels are here again. Chapter 13 bankruptcies, which are used a lot to save ownership of a house, have rose significantly this year. And of course, servicers will dump non-performing assets rather than try to manage lengthy foreclosures oftentimes. And that creates opportunity for us as note buyers. And so, banks are under pressure to improve their liquidity. The FDIC is using banks to reduce non-performing assets, NPAs. And, guys, historically, when this happens, banks are getting ready to unload or offload distressed loan portfolios to the secondary mortgage market. And the secondary mortgage market, for all of you, is where folks like us can actually buy mortgage notes, real estate debt as an asset. We can buy this just like stocks are traded on the stock market, cryptocurrencies are traded on the crypto market, and there's a secondary mortgage market where these mortgage notes are traded. And so, when the banks and when the larger institutions start to offload large sets of what they call pools or tranches of these mortgages to the secondary mortgage market, what that does is it floods it with inventory and opportunity for us as note investors or note buyers. And the commercial collapses is not helping anything. If you guys know commercial real estate, those kinds of things. The defaults in those, the default rates have already been spiking quite a bit. A lot of people didn't even go back to the office after COVID. So regional banks are overexposed to commercial assets. And, a lot of times the big regional banks are these large institutions that hold portfolios of commercial and residential paper. In times like this, where you have this, I guess, overexposure to commercial loans, which are way up in default rate and things like that. Now they might sell residential non-performing loans in order to offset losses, so that can happen, and it makes a little what we call ripple effect or trickle down effect. What about housing market stagnation? There are some places that got overbought. They got overpriced. They got overbought. There was a lot of migration, during and after COVID, and prices have stalled, even gone down in many markets around the United States. And so, if a homeowner doesn't have the ability to have an exit strategy, right? The homeowners that are upside down and they have little or no equity, they, can't any longer afford the mortgage payment. Well, you go see the movie The Big Short, and you'll find out that people, again, were just walking away from the properties, literally putting a magnet with a note on the refrigerator of their house saying, "Hey, bank, we can't afford it no more. And we're out of here. We're moving to a different place. The house is yours," and just leaving. Okay. And, so that can happen. Of course, not like, the catastrophe in 2009 and 10, but, still, rather than go to foreclosure and these kinds of things, these people are just walking away, giving the houses back to the bank. Okay. And then growing loan modification fatigue. Understand that a lot of borrowers reached out and got loan modifications and things like that between 2020 and 2022. And now a lot of those are redefaulting again, if we understand that. And so, like, loan modifications only usually delay foreclosure proceedings. And when a loan modification fails, it usually goes directly to non-performing note status. And a lot of times these notes will hit the secondary mortgage market, giving opportunity for us. And of course, Servicing, outsourcing, problem loans. Okay. Servicers and sometimes owners and institutions don't like these notes, and they're not good for the books. And so they'll package like what they call scratch and dent loans, which are loans that kind of pay and don't pay, and then they're late 2, 3 months and they catch up and those kind of things. Don't have a great pay history. And they'll often package these with non-performing loans and pools and put them out there on the secondary mortgage market. And this is often time, about a 12 to 18 month indicator before major volume of mortgage notes like this in the non-performing space and scratch and dent space hits the market. So, anyways, I just wanted to inform you about kind of some of these indicators, right? And why, you know, we don't want to ever see disaster in the marketplace. No, of course not. When people start to lose their homes and economic disaster hits, it's never a good thing. But if you look at the, Warren Buffett, I guess, style of an investor who's going to understand that there's opportunity to be had also for those who are prepared when blood hits the streets. And so, I think the smart investors are people who want to take advantage of the upcoming opportunities. Excuse me. They're building capital relationships. They're learning how to be a pro in the note investing space, by due diligence, pricing models, acquisition strategies. People are building their servicing teams and workout systems and those kinds of things, forming entities, maybe even a small investment fund, and then plugging in so that you are there and ready when the non-performing note deal flow hits the market. And one of the cool things, guys, is that yes, the reason why non-performing notes are awesome because there's lots of spread, there's lots of room, there's lots of ways to make a really good amount of money as an investor buying up non-performing notes. But also remember that with that comes responsibility. And some of these larger institutions, larger banks and things that own millions of mortgages, when someone's calling or needs help, needs a loan mod, they're not listening to the story. They've got a gatekeeper, and the person that they're talking to is a bank teller on the phone, doesn't know better, and has to refer them to a department. You know how it is. We're just a number to these people. And so as a note investor, we have the ability to do things that maybe these institutions would not do for these homeowners. And we're able to do so many different things for folks prior to, say, actually doing a judicial foreclosure and kicking a family out and taking back a house, right? There's so many different things we can do to not only profit and benefit as a financial investor in the space, at the same time, though, with good heart and good morals, at the same time as making good profit, help a family maybe stay in their homes. Okay. So, you guys will learn to understand that, kind of at the back end of every video, I want to go over, of course, how I can offer value and just help more people out there with, resources that I have. And so, if you are somebody out there and you don't want to become a pro at anything, and you like the idea of real estate investing, you like the idea maybe of mortgage note investing and what it does and why it's so awesome, maybe apartment development, those kinds of things, down in the description of the video, I'm always going to go over how I can help you. And if you're a passive investor, you might want to check out our fund. We have a $250 million investment fund, Everly May Capital Group, and we do manage over $30 million worth of real estate backed assets in that fund as we speak. And right now, our Doors to Prosperity program, we're building apartment buildings from the ground up right in the path of progress in Florida. And so if that sounds exciting and you just are an investor, you have IRA, 401k, or cash, and you're looking for a good management team, great real estate backed assets, and a good investment opportunity, check out Everly May Capital Group. That could be for you. And, if you want to learn about cash flowing from real estate, without owning real estate, for instance, like buying non-performing notes, what I described to you in this video today, well, maybe you want to look at enrolling in the Note Investor University. We have a school where my partner Desi and I teach you all the dynamics of note investing in the real estate debt, not the actual real estate, performing notes, non-performing notes, first lien, second lien, and all sorts of different types of exit strategies and theories on how you can monetize the opportunity for yourself without the headaches of being a landlord. Go and check out noteinvestoruniversity.com. and we can help you learn that skill. Now, we utilize, as you'll hear in my videos, dynasty trusts and family trusts to create protection and shielding for our family, for our wealth, to pass our wealth down to our family, and also to create our own family banking system to continue perpetuating wealth for generations in your family. Then you might want a discovery call with me, and you can request one of those, and I'll speak with you personally to decide, maybe on the discovery call, what kind of trust would be good for you and your family. I'm not a trust attorney and I don't make money off of these things. This is just how I can help point you in the right direction, for your wealth building. And we use life insurance to protect our wealth. And to pass along wealth to our family members, and to grow wealth with compounding. And we use life insurance policies, specially designed life insurance policies, to do that. And so if you want to learn how to do that, create your own family banking system, which I think every family should do, then you can check that out in the link below, and we can help you start to establish your own family bank. And of course, you can check me out there on all of the social media channels, okay, at the Patrick Franz, because I'm the Patrick Franz. And so you can find me out there on all the social media channels if you want to link up with me on like Facebook, Instagram, and those kinds of things there. And so, guys, as always, I hope my content was helpful. If you got something out of this video, support me. Hit the subscribe button. And if you want to get notified for more educational videos about health, wealth, and legacy, hit the little bell next to the subscribe button and you'll get notified next time I go live. And I'm planning on going on a run here, so I plan to deliver as much value to my audience out here on YouTube as possible. I appreciate you all. And as always, guys, stay sharp, stay strong, stay free. Okay, I'll see you in the next one.